Hello and welcome to Chapter 21, Thrifts and Finance Companies. So, first of all, this use of the word thrifts. Thrifts is a uniquely US concept. It's the idea of basically anything that isn't a commercial bank, classified as a commercial bank. Now, to set up a commercial bank, as you know already, you need to have a charter. And all commercial banks are obviously for profit. So when you're looking at thrifts, there are a variety of different ways to organize, which sometimes these are not for profit or for the benefit of the customers, and sometimes they are for profit. So they come under a variety of different names, but they are not commercial banks. So when we refer to thrifts, basically we refer to one of three types of institutions. First of all, savings banks, and these can either be mutual savings banks or what we call savings and loans, or S&Ls. And I'm going to talk about what those are. So that's one, two, or the third thing that they could be is a credit union. So credit unions also fall under the idea of thrifts. So thrifts is really a very general term that's used to indicate a non-commercial bank, financial institution that acts like a bank. So some people call these non-bank banks, which is very confusing, because how can a bank be a non-bank? But hopefully you get the idea. It's really a non-commercial bank depository institution, or a non-commercial bank depository institution. Okay, let's look at the first type. It's called savings banks. Sometimes these are called mutual savings banks as well. Their original goal was to provide a way for the poor in society to save. And a variety of different countries actually was involved in the development of this idea. The first savings bank was actually set up in Germany, in Hamburg, in 1778. So they have a really very long history. In the US, basically the first one was in 1816 when the Massachusetts state government set up a US savings bank. The savings bank deposits are insured by the FDIC or a state-regulated scheme. So it depends on who regulates the savings bank. And once again, there's a kind of a dual system here for these savings banks, whether they're regulated at the state level or at the federal level. These are small institutions, and they're usually very local institutions, so their assets tend to be less than $1 billion. And most of them are located in the Northeast. They're often called S&Ls or savings and loans as well. So what's their primary focus? If you look at their balance sheets, their assets are mainly real estate. So in other words, really what they do most of is house loans and car loans for consumers. So they're not involved in loans to business in general. The whole idea of these S&Ls originated in the UK as what we call building societies. And in the UK, the building societies were set up not as a bank, but as a society that would fund building. In other words, putting up buildings, essentially. That's the idea of a building society. And in the UK, there's lots of building societies still exist, although there's been lots of consolidation in the building society area. So you have Nationwide Building Society. I have an account with them. I have the Leeds Building Society. Most of the building societies in the UK tend to be associated with a certain area of the country. Not always, though. And the idea basically spread to many countries. So it began in the US as a building and loan association. And basically a group of people would pool their money together for the sole purpose of building homes, hence building society. Sometimes these were also called mutual savings banks. Why? Because when they made profits, these profits were shared, were basically given to some of the people who pooled their money in as well. So these aren't necessarily the idea of not for profit. So these are not for profits. So they aren't credit unions. Credit unions are not for profit. So, as I said, the idea of a thrift is a non-commercial banking type institution. And these in the US were developed under what they call the FHL bank system. This was supposed to parallel the commercial banking system. And the idea of having the Federal Home Loan, the FHL bank system, was to kind of mirror the idea of having some kind of Federal Reserve system. But it was very different. So President Hoover signed the Federal Home Loan Bank Act. And the goal was to create a government-sponsored lender to thrifts that made consumer mortgage loans, small business loans, agricultural loans, and rural economic development loans. So the idea here was kind of a lender of last resort to the thrifts here. That was the original idea. Why is this? Why are they doing this? And why are they encouraging? You could see President Hoover kind of was encouraging these thrifts to get into small business loans, agricultural loans, and the rural economic development loans. So outside of their wheelhouse, which was consumer mortgages. Well, these thrifts were considered special. And as time went on, for instance, in the 1970s, commercial banks were subject to Regulation Q. Now, Regulation Q, if you recall, limited how much commercial banks could pay in interest to its depositors. Now, thrifts never had that kind of limitation. So, although banks were capped in terms of how much they could pay in interest, the thrifts didn't have any nationwide regulations on interest or dividends. So the thrifts tend to try and compete with the banks and try and attract business away from the banks. What we call disintermediation from the banking system. In other words, instead of funds going through the banking system, they went through some other conduit, in this case, the thrift industry. Why did they go through the thrift industry? Well, the thrifts were able, because of Regulation Q on the banking sector, as that commercial banking sector, didn't apply to the thrifts industry, they were able to pay higher interest rates on deposits than the commercial banks. So there was a kind of a flow of funds away from the commercial banks and towards these thrifts. Now, the balance tipped more in favor of the thrifts as we move into the 1980s, due to Congress passing what was known as the DIDMCA, or DIDMCA, the Depository Institution Deregulation and Monetary Control Act. This in itself was a major deregulation of the financial services sector. So it caused Regulation Q to go away. That meant that banks could set up different accounts. They could set up accounts which they didn't call checking accounts, they called them something else. So checking accounts that paid interest to avoid restrictions on those regular checking accounts. And often banks call these NOW accounts. NOW stands for Negotiated Order of Withdrawal. I think we've done that in a previous chapter. But what that meant is that because the thrifts had already kind of gotten into these new sectors. They'd already kind of exploring lending to small businesses, lending to agricultural farms, doing economic development type loans, that now they had to properly compete with the bank. So that meant they really did have to pay higher interest rates than the banks could pay. And they also lobbied to have that kind of written into law, that they could actually go beyond just the small business loans and get into larger business loans. The Garn-Saint-Germain Depository Institutions Act of 1982 allowed these S&Ls to write a variety of loans legally. They had very little experience, of course, in writing some of those loans for bigger clients, but they were desperate for loans with high interest rates. Why? Because that allowed them to continue expanding. They didn't want to contract. They were looking at expanding. What that meant is that, of course, that they had to lend to make themselves profitable. If you think about it, if they're paying out higher rates of interest than the banks, it means they've got to find projects that pay them back a higher rate of interest as well. So their loans are going to go to customers that will accept a higher rate of interest. Well, who are those customers likely to be? Well, there's clearly here an adverse selection problem. Why? Because if the loans you are offering a higher interest rate, because you have to charge a higher interest rate because it's the only way you can make money, because you're having to attract more funds into the business through paying higher interest rates compared to the banks. So now who's going to come and want those higher interest rate loans? Well, obviously the more risky type of businesses, the types of businesses that the banks probably would not be interested in loaning any money to. So they flocked to the S&Ls. And the S&Ls, without any experience in many of the sectors that they were now getting into, wrote many risky loans. Obviously, the incentives were completely misaligned here, and this was a big problem with deregulation in the early 80s. So the savings and loans could now make risky loans with corresponding high interest rates. If those risky loans paid off, in other words, if the business that took the loan did well, great. If not, remember, there's a greater likelihood that they wouldn't be successful because the banks wouldn't touch them. So they're definitely going to be more risky. So there's definitely an increased probability of failure. There was still deposit insurance for the depositors. So the S&L said, well, it doesn't matter if it doesn't work out. You know, the depositors could turn to the government and get repaid. So we don't have to worry about that. So there was an adverse selection problem in terms of the loans that they were giving out. And then there was a moral hazard problem in terms of the fact that there was the deposit insurance there for them. So the amount of risky loans and high-risk bonds held by the savings and loans increased dramatically during the 1980s. Even worse, they deceived depositors and regulators and used the S&Ls as their own personal piggy banks. There were various lawsuits that were brought against S&L presidents for actually running money laundering type operations through S&Ls. Corruption was rife in some of these S&Ls as well. Texas in particular was really subject to this, particularly around the Waco area, Waco, Austin, north of Austin area on the I-35 corridor there. There were a ton of S&Ls that were doing all sorts of stuff. So the S&Ls saw it simply as a game of heads I win, tails the government loses. So what have we got to lose? Let's find those customers. What made things worse was the rise of the zombie institutions. Why? Because the S&Ls themselves, many of them went insolvent. But because they were very cozy with the regulators, the FHL, the FHL basically turned a blind eye. And once again, there was not proper regulation of these institutions. And so there were some S&Ls that were basically in a terrible state. They were basically bankrupt, but they weren't closed down. So what they had an incentive to do was to try and resurrect themselves, try and rescue themselves from the plight they were in by, well, let's make even more loans. Let's increase the interest rates to get more money in, and let's hope that the next few loans that we make turn out better. Well, there was that clear moral hazard problem led to some real problems and a run of bankruptcies that hit the national headlines. And so by the end of the 1980s, Congress was trying to kind of grapple with the problem of what to do about these S&Ls, that many of which were already zombies. And George H.W. Bush signed the Financial Institutions Reform, Recovery and Enforcement Act, or FIRREA. FIRREA abolished the Federal Home Loan Bank Board, the FHL, and created a new Office of Thrift Supervision, OTS, at the Treasury Department. But something had to be done in terms of the deposit insurance scheme, because that was bankrupt, completely bankrupt. So the FIRREA had to basically provide taxpayer money, and $50 billion of taxpayer money, which I don't know how much that would be in today's dollars, but it's not nothing. It's a large amount. Had to be supplied to basically pay off the depositors and close down those zombie institutions. And to do this job, the Act created a new entity, basically a board, the Resolution Trust Corporation, which was, this government agency or a board from 89 to 96 that basically was in charge of liquidating those insolvent thrift institutions, selling off their assets, and arranging mergers and bailouts for bankruptcy by still operating those thrifts. So it was a way, I think the Treasury realized that this was a huge problem and was kind of beyond them just doing something very quickly. They had to kind of wind the thing down slowly. So as you can see, they took around 7 years to do it. Nevertheless, the S&L crisis of the 1980s really shook the thrift industry to its core. It also shook the Texas government to its core, because it caused a really sharp and nasty recession in Texas in the early 1980s. And so beyond that point, as we're going to see in a future slide, Texas kind of decided it was going to have to take its future in terms of banking into its own hands. We're here already. So Texas is the only state to then decide in 1994 that they were not going to be part of the Regal-Neal Interstate Banking and Branching Efficiency Act, which allows banks to branch, in other words, to open branches across state lines. So a bank like, kind of say, Bank of America or Wells Fargo Bank, the way it expands across the country is to, use the interstate banking law. So, those banks could not expand into Texas. Why? Because Texas had its own set of banking laws. So if you bank with one of those institutions, just look at your checkbook and you'll see the name of the bank that you bank with is Wells Fargo Bank, parenthesis, Texas, parenthesis. So they had to set up a separate bank, a separate subsidiary in Texas, which is then regulated by the Texas Banking Authority here in the state. And so you can see this was nearly all due to the S&L crisis. And we're the only state in the country that is not part of this Regal-Neal Interstate Banking and Branching Efficiency Act. You can find about a really interesting history, by the way, of banking in Texas at that link there. So what about thrifts today? Let's give you a bit of a background on thrifts. Well, the main focus obviously is to provide financial services of various different kinds to consumers. And when I mean consumers, I don't mean small businesses, I mean consumers, households. So almost 40% of the thrift's assets are in real estate loans, in mortgages. By way of comparison, the commercial banks have only around 25%. So thrifts are way more invested in households. Commercial loans, on the other hand, are only about 4%. As I said, it's a very, very small amount of loans going to businesses. And that's in comparison with 12% for commercial banks. While this might represent a return to the traditional role of thrifts, oh, by the way, you're probably looking at the percentages and thinking, oh, that's only 44%. What about the rest? Well, a variety of other different loans as well. Auto loans is a big one. And also these thrifts as well hold assets. They hold T-bills as well, obviously, like banks do. So, it doesn't mean to say that the SNLs are not without their unique set of problems. And this came to light during the Great Recession, 2007 to 2009, when the Washington Mutual Savings Bank, it stands for, the nation's largest thrift at that time, failed in 2008, and it went underwater. Why was there failures in the thrift sector? Well, simply because of the real estate problems that the country was undergoing during the Great Recession. So, the trouble is 40% is a lot of assets to have in real estate loans. And of course, the Washington Mutual, for instance, had a lot of loans based in certain markets where house prices really took a plunge, and house owners walked away from their mortgages. In other words, they were so underwater in what they owed compared to what the house was worth, they just walked away from it. And then the bank had to try and pick up the pieces because its loan that it had made, it couldn't recover that by selling the property, even after it had foreclosed on the property. So that's one of the reasons why now, by the way, the requirement for getting a mortgage is so much higher than it was prior to 2007 to 2009, and it's because of the experience of the banks and the SNLs. Let's now move on to credit unions. They are the other type of SNL, thrift, I should say. So with thrifts, there's really, just to go back over this again, when we talk about thrifts, we talk about savings and loans and credit unions. So the third kind of leg of this is the credit unions. So credit unions, a little bit different from SNLs, because credit unions are a collective institution. So they're a non-profit. They do make profits, but they are paid to their members, and their members are the depositors. So it's like a cooperative. So they're a non-profit financial institution whose members have a common bond. And originally they were set up such that they had to have some kind of common bond between the members. So the members had to be either farmers or in a particular industry. So for instance, there's a Chemcell credit union I've seen. Well, that's chemical industry workers credit union. Navy Army credit union. Well, that's members of the Navy and the Army. What the Air Force did, I don't know. But anyway, you understand why these credit unions then have these specific kind of names. There has to be a bond between them. So it could be a place, it could be an industry, it could be, particular workers. They don't pay corporate income taxes, and they pay higher interest rates on the deposits, and they charge lower interest rates on loans than their stockholder-owned competitors. So if you want from a bank just a mortgage or an auto loan and a decent rate of interest, they're probably the best place to go. Forget international services though, you won't get any of those through a credit union. So if you, for instance, you want to transfer money abroad or have money transferred into your account, it's almost impossible with a credit union. It's incredibly difficult. So I used to be a member of a credit union, and because I have money coming in and out of the country due to my family still being in the UK. Credit unions just didn't work for me. Much though I like them, I think they're really good institutions. At any rate, so they're owned by their members. So when you open an account with a credit union, you actually have to open two accounts. What do I mean by that? You have to open a share account. That is, you have to put a minimum amount. Most credit unions, it's around $25 into an account. Sometimes it can be up to, it can be more than that, $100 into an account. That's equivalent of buying your share of the credit union. And then, of course, you have your regular checking account. So you have two accounts when you open an account with a credit union. Okay, the first credit union actually began in Canada. It began in Quebec. And as I lived in Quebec for some time, I know all about the credit unions in Canada. Alphonse Desjardins, by the way, the biggest kind of shopping center in downtown Montreal is called the Desjardins Center, the Centre Desjardins, after Alphonse Desjardins, because he organized the first credit union in Lévis, Quebec. And in 1909, he helped establish the first credit union in the US as well, in New Hampshire. In Quebec, they're not called credit unions, they're called in French caisse de dépôt. So it's a counter of deposits, a counter for deposits. And it's the largest financial institution in the province of Quebec, incidentally. The Québécois, as they're called, or Quebecers in English, still really like their caisse de dépôt. So while credit unions traditionally have offered financial services predominantly to households and individuals, in recent years they've actually been branching out and offering small business loans as well, and allowing non-common bond members. So now, for most credit unions, you can walk in and open an account, even though, for instance, you're not a member of the military, if it was the Navy, Army credit union, or a farm worker, or chemcell, a chemical worker, or whatever. Those kind of rules have been relaxed. So there are controversies, though, surrounding the credit unions, and they are as follows. They don't pay corporate income taxes because, of course, the benefit is supposed to go back to their members. And it does go back in the form of dividends, which get paid into their shareholding account. So do credit unions receive an unfair subsidy from the government? The banks are not happy about the credit unions apparently not paying, corporate income tax like they have to pay. So should credit unions be allowed to dedicate more of their assets to small business loans, expanding into commercial banks' traditional market? It's a good question. Are these non-profit institutions that focus on the local economy the wave of the future? One of the problems that credit unions have is they're usually small, and therefore to kind of create the technology infrastructure that they need, for instance, for things like online banking, that has been a struggle for them. So there have been much less innovative, I should say, in terms of what they've been able to do there. Or do they represent yet another distortion in the financial markets brought about by outdated regulations and subsidies? Good questions. I don't have the answers to those questions. These are all questions that are being asked or have been asked of credit unions and their place within the financial services sector. Last type of institution that we're going to turn to isn't part of the thrifts. It's a finance company. Now, finance companies provide basically what we call HP, or hire purchase loans. Hire purchase means usually purchasing of some article that requires you to take a loan. So in other words, it's financing of something. Now, the most obvious one there is the auto loan. And if you go and buy a new car, you'll be taken into the finance director's office and you'll be told exactly what kind of loan they can offer you. Now, of course, the dealership isn't offering you the loan. Usually it's the arm of the auto company that's offering you the loan. And usually what happens is that loan is then transferred to another institution. So for instance, when I bought my first Land Rover, then they transferred that over to Chase Bank. So, my loan was written by Land Rover, but all the time in the background, they were checking that Chase would take my loan from them. So basically they were negotiating the loan. And of course, it's another way in which the auto companies can get commissions from the banks. Some auto companies actually have set up their own financial institutions that hold those loans. So they don't sell them on immediately, they hold them. So for instance, Toyota Financial Corporation is exactly that. And that's because in Japan, you have these very large industrial conglomerates, and Toyota is one of them, such that not only will it have cars, but it'll also make other things, maybe tanks, and it also has the Toyota Financial Corporation, which, will make loans against those things. And so the object there is not necessarily to sell those on. Those finance companies can also fund mortgages. And if you go through a mortgage broker, often they will not only try the banks out, but they'll try these finance companies out. So I refinanced my mortgage recently, and the company that refinanced my mortgage already sold it on to someone else, I believe, but it's still doing all the administration for it, is a finance company. Or obviously consumer durables. Whenever you go and buy a fridge or a freezer or anything that's a big ticket item, you're usually offered some kind of loan as well to afford that. And then there are service finance companies as well. So if you go and get your teeth fixed, for instance, or go and get cosmetic, what's commonly known as plastic surgery, you'll often see leaflets on the counter of the cosmetic surgeon's office, where they're offering financing to do those particular services. Lawyers as well. Medical as well. So those are all finance companies. With these business credit institutions, so these are business finance companies, there's less regulation over business lending than consumer lending. So you can also have finance companies that focus not on consumers, but focus on lending to businesses. So in particular, agricultural businesses, I know are one big area where there are many finance companies trying to write loans. Finance companies also provide a variety of loans and services to those, what's called floor plan or inventory financing. That's so that businesses can basically fund their inventories. Leasing type of loans. So if you lease a car, for instance, basically the lease covers effectively a payment to a business financing company. Accounts receivable financing. So that's for when a company is about to receive or has sold something but won't receive the payment for a number of days or months, could be 90 days. if it's a big ticket item that the company's sold, then it may finance that, so to keep it self-solvent. So it's sold whatever it's made and delivered it, but it's not going to receive payment for 90 days, which is often the case, 90-day receivables, etc. In which case, if it's a small company, it might get some financing to cover it, to tide it over. Why? Because it doesn't want, it wants to get the money immediately for what it's done, so it can start making more of those things. Otherwise, it can't do anything because it hasn't got any money coming in for that 90-day period. So these types of finance companies, I've already kind of covered a little bit of this, but let's look at how they're set up within the context of the financial services sector. So there's captive sales finance companies. These are owned by a parent company established to help purchases of goods sold by a parent company. So for example, Ford Motor Credit Company or General Motors Financial or Toyota Finance Corporation, etc. So that's when you buy it. Do you want to finance some of it? Sales finance companies. They originally started out as captive sales finance companies, but now they finance the purchase of goods made by other companies. So GE Capital is an example of that. GE Capital is actually spun off as a separate company now from GE, General Electric, and it finances purchases of all sorts of things. It doesn't have to be a GE fridge or etc. or a GE engine for an aeroplane or something like that. Could be anything. Bank subsidiaries, they sit within the bank holding company. So oftentimes you'll have a bank sets up a bank holding company, which in organizational terms basically is above the bank in terms of the structure of the company. And this bank holding company then can own other things like an insurance company or a finance company. And they offer services to bank customers, both individuals and businesses that may not qualify for the bank's traditional loans. So for example, HSBC, that should be HSBC, not HBSC. It's Hong Kong Shanghai Banking Corporation. But they've set up a subsidiary called the HSBC Finance, which arranges loans for businesses. Those loans are specific to some of the things we've covered already. So things like, accounts receivable financing or inventory financing. Independent finance companies. There are many local finance companies. Many of these offer payday loans or title loans as well. So these independent finance companies can do mortgages like one I've got, which is a very, very competitive market, or they could, so through a mortgage broker, or they could be these finance companies that do payday loans that are usually earn an extortionate rate of interest for them, or title loans. These are loans made where the finance company will hold the title of your car. In other words, will own the car, basically, if you don't pay the money back. And once again, those are usually at very high rates of interest. So finance companies, just to make this very clear, are not depository institutions. So in other words, the finance companies don't have depositors. So they're unlike, that's why they're not part of the thrifts. They're unlike, thrift means saving, to be thrifty means to save money out of what you have. So thrifts are depository institutions. They're just not banks, not commercial banks. Whereas finance companies don't have any of that depository side. What they have is a bunch of investors who come together, put up the money to loan it out and make money off of that. So finance companies are usually partnerships. I noticed that my mortgage is from a finance company. It's a partnership. So they cannot fund their lending through deposits. Finance companies are usually highly leveraged entities. Highly leveraged means that those investors will put up the money, and based on that, the company will go and try and borrow money from elsewhere, or even start issuing stocks on the stock market in order to fund their lending. So they usually borrow in order to lend. So the founding members put up the capital, the original capital, but then the company usually goes out and borrows money as well in order to lend out at a higher rate of interest. There have been some controversies as well with finance companies. So during the 2008 financial crisis, many finance companies were accused of misrepresenting the risks of adjustable rate mortgages. There's a famous finance company called Countrywide, which was bought out actually by Bank of America. But Countrywide basically was a finance company that did mortgages, and there was lots of illegal activity that went down at Countrywide. Things like not really being open about what type of loan you were getting, and not properly explaining the type of loan that you were getting. So some allegedly recklessly offered second mortgages for more than the home was worth. So things, just like that, doing things just like that just to get the commission off those things as well. So in 2014, American Express, along with the Young Turks, funded the creation of a video to explain this and explain why it's not a good idea generally to get a payday loan. It's not a good idea to get a title loan unless you absolutely have to. These are extremely high rates of interest, and they're also have a large amount of covenants, a large amount of conditions that is attached to them. And things like if you're a day late, suddenly there's an extra X% added on, and there's a penalty fee, and all the rest of it. So the finance companies are pretty controversial when it comes to taking advantage of people, and particularly poorer people, and maybe more uneducated people as well when they get loans. So they're famous for having a lot of small print, which you really have to read, because if you don't, you're liable to get caught out with something. And anyway. So, some group discussion questions. Let's quickly review these. What was created as a means for the poor and working class and extends to a much deeper issue, discrimination? Well, this is to do with the finance companies, and so the S&Ls were created as a means for the poor and working class, and actually, I don't think it does deal with the finance companies. I think it deals more with the S&Ls. And, the discrimination here is the fact that many in certain communities just couldn't get loans from banks because of the discrimination that bankers had against certain communities. So, for instance, new immigrants from Poland, Sweden, and Italy faced discrimination when they attempted to borrow money from commercial banks for home mortgages. So these communities often created their own S&Ls. So while the Great Depression reduced the number of thrifts, the post-World War II economic booms saw the thrifts thrive. As Americans wanted and needed more houses, the thrifts were there to help with financing. With low market interest rates, thrifts lived on the 3-6-3 rule of banking. Pay 3% in deposits, lend money at 6%, and hit the golf course by 3 p.m. Would the 3-6-3 rule work in today's banking industry with the competition and regulations that are now in place? I don't think they would. The world's changed quite dramatically, and the regulations now surrounding S&Ls is a lot more strict. So in 1990, this is number 3, the Washington Mutual, then a medium-sized thrift in Seattle, hired a new CEO, a 40-year-old named Kerry Killinger. Killinger's goal was to create a huge financial institution that would be more retail than banking. In 2003, he stated, we hope to do to this industry what Walmart did to theirs, Starbucks did to theirs, Costco did theirs, and Lowe's, Home Depot did to their industry. He wanted to revolutionize the thrift industry by providing a wide range of debt instruments, mortgages, consumer loans, credit cards, and so on, to people who traditionally did not qualify for such credit. What was the outcome for Washington Mutual? Well, as you know from the PowerPoint, Washington Mutual went bankrupt. And that's the end of this chapter. So here's a quick summary of what we've covered. Thank you for listening. Goodbye.